Your IRS debt has an expiration date. I'm serious. There's a specific day already set when the IRS loses the legal right to collect from you. The balance doesn't just get reduced, it doesn't get settled, it disappears. The IRS writes it off and walks away. It's called the Collection Statute Expiration Date, the CSED, and it might be the single most powerful number in all of tax resolution. And here's the part that should make you sit up. The IRS will never tell you what yours is. It's not printed on a single notice they send you. They're not in the business of reminding you that if you can just hold on, this whole thing goes away. I've watched people owe the IRS for years and never once find out they had a finish line the entire time. Here's how it works. From the moment that the IRS officially puts a tax debt on your account, they have exactly 10 years to collect. 10 years. After that, by law, it's over. But pay close attention to when that clock starts, because almost everybody gets this wrong. It doesn't start the day you filed. It doesn't start on the April due date. And it doesn't start when you got that first scary letter. It starts on the date of assessment, the day the IRS formally recorded the debt on your account. For most people, that's a few weeks after you filed the return, sometimes the same date. If the IRS filed one of those substitute for returns for you because you didn't file, the clock starts when they process that. If the debt came out of an audit, it starts when the audit was finalized. And here's something most people don't realize. Every single year you owe has its own separate 10-year clock. They don't all expire together. If you owe for 2017, 2019, and 2021, you've got 3 different expiration dates running at the same time independently. Your 2017 balance might be about to die when your 2021 balance still has years left on it. You could have one foot out the door and not even know it. Now here's where it gets tricky and where you have to be careful, because certain things you can do stop the clock. The lawyers call it tolling. The clock freezes and it doesn't start again until whatever you did is finished, usually with extra days tacked on the end. Filing an offer in compromise stops the clock the entire time it's pending, plus 30 days after. So if you file an offer and it takes the IRS a year to say no, congratulations. You just handed them an extra year of collection time. Requesting a collection due process hearing stops it. Filing bankruptcy stops it for the whole bankruptcy plus another 6 months. Leaving the country for more than 6 months straight stops it. Asking for innocent spouse relief stops it. And here's the part that most people miss, and it's the trap. Every time you fight the IRS, every time you ask them for something, you may be quietly extending the very clock that's supposed to be running out in your favor. Sometimes that's worth it. Sometimes it's the worst thing you can do. You have to know your dates before you can make a single move. And now the piece that almost nobody understands, the one that's worth this whole video. A regular installment agreement, an actual payment plan that you're making payments on, doesn't stop the clock. The clock keeps on ticking while you pay. Well, think about what that means. You can get on a payment plan you can actually afford, make the modest monthly payments, and let the 10 years run out underneath you. When the expiration date hits, whatever's left, even if it's the most of the balance, it expires. It's gone. I've had clients pay a few $100s a month on a 6-figure debt and watch the bulk of it evaporate at the expiration date. They paid a fraction of what they owed completely legally just by understanding the clock and using it instead of fighting it. Let me give you the actual math. Say you owe $100,000 and your expiration date is 3 years out. The IRS can only collect what they can squeeze out of you in those 3 years. If you can afford $500 a month, that's $18,000 before the rest dies. Why on earth would you scrape together $40,000 for an offer in compromise on a debt that's going to expire for almost nothing in 3 years? You wouldn't. That offer would be a gift to the IRS. Now flip it. Say the same $100,000 has 9 years left on the clock and you've got real income. Over 9 years, the IRS could collect more than you even owe. In that case, an offer to sell for less suddenly makes a lot of sense. Same exact debt, opposite strategy, and the only thing that changed was the expiration date. If your advisor isn't calculating that date before recommending anything to you, they're guessing with your money. How do you find your number? You're not going to get it from a notice. You pull your IRS account transcripts, and on there, your assessment date shows up as a code transaction 150. You'll find that date, you add 10 years, and then you carefully adjust for every tolling event on the account, every offer, every hearing, every stretch out of the country. Get this right, and you know exactly where your finish line is. Get it wrong, and you might make a payment you never had to make, or file an offer that hands the IRS years they didn't have. This calculation is not a place to guess. Here's the bottom line. For a lot of people, the smartest, cheapest, cleanest way out of the tax debt isn't a settlement and it isn't a fight. It's understanding the clock, protecting it and letting it run out the right way. But you can't use a finish line you can't see, and the IRS is betting you'll never look for it. After 32 years of doing this, I've watched people make huge payments on debts that were months away from expiring just because nobody ever told them the clock existed. Don't be that person. If you owe the IRS, let's talk. We'll pull your transcripts, calculate your real expiration dates down to the day, and figure out whether your best move is to settle, to fight, or to simply outlast them. Knowledge is protection. Let's go find the finish line. See you in the next one. Thanks for watching.